Welcome back to the final chat that we are going to have about long-term liabilities. We're going to spend a lot of time here talking about bonds. So like I told you, you have bonds, notes, and leases. We've talked about installment notes already. Leases we'll cover in a more advanced accounting class. But bonds do a really good job of just showcasing how long-term liabilities should be captured. So what is a bond? It's a formal debt agreement issued by a company to borrow money. So the issuing company promises to pay back the investor the stated amount, so the principal or the face value, and periodic interest payments. So traditionally, interest is paid on bonds semi-annually. Could be more, could be less, kind of depends, but semi-annual is a pretty good guess. So what that means is maybe you have N equals 30. You have a 30-year bond, right? So you have all of these different interest payments throughout the life of the bond, right? And then you also, so I'm going to pay $100 in interest all of these times. And then I'm also going to pay back the $100 million face value. So we call this the face value, right? Maybe I'll specify face instead of future, right? Face value. And then you have these periodic interest payments. So what this means, the bond price, right? Bond price is going to equal the present value of the face value, okay? Which is going to be the present value of $1. Then you're going to have the present value of an annuity for all of your interest payments, okay? So we'll talk a little bit more about that, but keep that in mind. A bond just simply is a formal debt agreement. So you have three options for bonds, okay? They can be issued at face value, they can be issued at a discount, or a premium. And we're going to walk through all three of these. But the first one is saying that a bond is issued at face value, okay? So what exactly does that mean? It means that it's issued, right? It's issued at its face value, and what's really important here is that the stated rate of interest is equal to the market rate of interest. And we're going to talk more about both of these things as we get into the conversation about discount or premiums. But when I read this, I see that California Coaster raises money for development of its new roller coaster by issuing $100,000 of bonds paying a stated interest rate of 7% each year. And the investor requires a market rate of return of 7%. So because these two things equal, okay, my stated rate equals my market rate. That means that they are going to be issued at face value, okay? They're due in 10 years with interest payable semi-annually on June 30th and December 31st each year. So the first thing I'm asked to do is book the journal entry for issuance. Well, what exactly is a bond? It's exactly that, right? It's a debt instrument. So what that means is somebody is giving me cash of $100,000, and I am promising to pay them back this bond. I have a bond payable, also equal to $100,000. Okay? So now I have interest that's going to come due on, say, June 30th and December 31st, right? Both of those 2 days for the next 10 years. So I'm going to pay interest 20 different times. So the first interest that we're going to say is just going to be on this June 30th, 2027. How do I recognize interest? What amount of interest am I paying? Well, I know that I need to recognize interest expense through my income statement. It's the cost of borrowing money. I need to reduce my net income by that amount. And I have 100,000 multiplied by 7%, my stated rate of 7%, multiplied by 6/12 because it's outstanding from January 1st to June 30th. So I have $3,500 in interest expense, and it's payable. So that means that I am paying cash out for the same amount. Okay. So again, I'm going to book this journal entry 20 times. Okay. I'm going to recognize interest expense 20 times over this 10-year bond. Now I'm going to retire the bond. When I retire the bond, what happens? Well, that means I'm paying cash. I'm giving this cash of $100,000 back to the person that I got this bond from, and I'm extinguishing my bond payable. I don't owe you $100,000 anymore because I'm actually going through the process of paying it. Okay. So what do you think this looks like? Well, it's very similar to what? My notes payable, right? Nothing fundamentally has really changed other than I'm just calling it a bond instead of a note, but it's operating the exact same because I issued it at face value. That's really important. Okay. So now I can issue bonds at what are called premiums or discounts. So now we're finally talking about the stated rate and the market rate of return. Okay. So what that means is the stated rate is specified in the bond contract, and that's the interest rate to be paid to the company by investors in the bond. So this right here is going to be my cash interest paid. Think about how we calculated our 3,500 in the prior slide. We took our stated rate multiplied by the time it was outstanding. Now you have this thing called the market interest rate. And the market interest rate is not specified in the bond contract, okay? The market rate over here is an implicit or implied rate based on the price investors pay to purchase a bond in return for the right to receive the face amount at maturity and the periodic interest payments over the life of the bond, okay? So all else being held equal, investors demand a higher rate of return, or a higher market rate, I should say, for bonds that have something that's called a default risk, okay? And default risk is just a company's not going to be able to pay it, right? Hey, it has a high probability of defaulting. It means they're not going to be able to pay the principal back. Maybe they're not able to make those periodic interest payments, right? So the higher the risk goes, right, the higher the default risk, investors can increase their rate of return over the life of the bond by paying a lower price at the issuance date. Okay? Think about that, right? So if a bond's stated rate is less than the market rate, okay, what that means is that they will issue below face value. So they issue below face value, and that means we are going to have something called a discount. Now, if the bond's stated rate is greater than the market rate, stated rate is greater than the market rate, then the bonds are going to issue above face value. So they issue above face value. And then we are in something called a premium. All right. So the only other option that you have is what we already saw before, and that's where your stated equals your market. Well, that is going to mean that you issue it at face value, and you have no discount or premium associated with the bond, okay? So you have to understand, right, that the stated rate, well, that tells you the cash interest that you're going to pay, but the market rate is what actually prices the bond. And that's what investors, right, are going out and saying, well, are you going to default on this bond? Because if so, well, you're probably going to have to pay me a little bit more than the stated rate. Otherwise, I'm not going to give you your money because I'm bearing risk that you're not going to pay me back. So I'm going to make you pay me a little bit more, okay? So what does that look like? Well, think about what this says. California Coasters issues 100,000 of its 7% bonds, but investors require a market rate of return of 8%. Okay, so stop right there, and I want you to ask yourself, is this going to be issued at a discount or a premium? Well, they say a discount, so I probably already know, but I have a stated rate of what? 7%. And I have a market rate of 8%. So I have a stated rate that is less than my market rate, which tells me I'm going to have a discount, and they're going to issue at less than my face value. So from a journal entry perspective, when I issue this, what I always want to start with is my bond payable. Because my bond payable that I'm establishing, that liability, well, I always put it on my books at the full face value of 100,000. But the bond's issued at 93,205. So what that means is that, hey, this bondholder, they're only willing to give me cash of 93,205. Okay, so what that tells me is I have a little bit higher of I have kind of a high default risk, right? So it's somewhat likely that I might not be able to make all of these interest payments, so they're not going to give me the full amount, right? So what that means then is I have a discount that I need to recognize, and I'm just going to call it a discount on bond payable, and that's going to be a plug figure of 6,795. That's a plug to get these two things to balance. All right. So what that means is that under my long-term liabilities section on my balance sheet, I'm going to see bond payable, and that's going to be at $100,000. That's going to be my face value. Now I'm going to have less my discount on bond payable. I'm going to show that as subtracting it out to get to the carrying value, right? How much is this actually worth to me of 93,205? Okay. So what kind of account do you think a discount on bond payable is? Well, it's a contra account, right? It's a contra liability account because it's acting to reduce, right, my bond payable. All right. So any difference, right? This is going to just be to get this to plug, and we're going to call it a discount. Now, what this represents, the amount of the discount, it effectively represents the additional cost of borrowing when I issued the bonds for 93,205, but being required to pay back principal of 100,000. Okay, so it's essentially just additional interest expense as we record each interest payment. So this, I'm going to say, essentially just additional interest throughout the life of the bond. All right. So what does that mean? Well, it means that we need to take care of that through my interest expense. Okay. So over here, we issued, right, our $100,000 bonds that have a stated rate of 7%, but investors require a rate of return of 8%. This has still happened, right? This is all effectively the same. But what this means is that we have to somehow recognize this discount, right? This discount over here as additional interest expense, right? So we use what's called the effective interest method to record interest on the bond. So not only do I need to recognize the cash that I'm paying you, I have additional interest expense as I chip away at this discount. Okay? So interest expense, notice this. Interest expense is the carrying value of the bond multiplied by the market rate. Interest payable, or my interest cash paid, that's going to equal my face value multiplied by my stated rate. And it's always going to be the same, right? Because I'm always making those same periodic payments. So here what I'm going to see is I'm going to say, well, how much cash paid interest am I paying? So I'm going to say interest cash paid. And what do? Well, I grab my 100,000 and I multiply by the stated rate of 7%. And I pay semi-annually, so I have 6/12. So I have a total of interest paid of 3,500. That should look familiar to you. But now, when I calculate interest expense, and this interest expense changes every time. Okay, this interest expense changes every time. Why? Because the carrying value changes every time. So what is my carrying value of my bond? Well, it's this 93,205, the issue price. So I have 93,205 multiplied by what? My market rate. My market rate of 8% multiplied by the 6/12 that it's outstanding. So all of a sudden, I have interest expense running through my income statement of 3,728. Okay. So this is important because my cash interest paid does not equal the interest expense that shows up on my income statement, right? Because I have additional interest because of this discount that I need to get through there. Okay. So when you think about how that feeds my journal entry, right? Well, what interest expense did I calculate? Well, the interest expense that I calculated was that 378.28, which remember was my carrying value multiplied by my market, multiplied by the time outstanding, 6/12. My cash paid, well, that was just 3,500, which was my principal, or just my face value, that never changes, multiplied by my stated, multiplied by my time outstanding. Okay. So my debits don't equal my credits, right? And that's fundamentally a problem. So what am I trying to get rid of? Well, I'm trying to get rid of my discount. I'm trying to chip that away. So I have my discount on bond payable that I get rid of now for the plug figure of 228 to make that go away. So if you think about it, my discount, well, I started with, let me see here, what is that discount? 6,795. Oopsies. 6,795. I just reduced it by 228. So how much is left over in this discount? Well, I get my handy dandy little calculator out. Let me do this math super quick. Should be 6,567. Because I'm trying to bring that discount to zero. I'm trying to get rid of it. And I get rid of it through the effective interest model that I'm using right now. So pause the video and see if you can figure out the second semi-annual interest payment. Well, the first thing I'm going to start with is saying I know my cash is always going to be this 3,500, which again is just my 100,000 multiplied by 7% multiplied by 6/12. That never changes. Now, how do I calculate my interest expense? Well, I need my carrying value. And what is my carrying value? My carrying value is what I started with, my 93,205. And I added 228, right? So I'm adding that to my carrying value. And now I'm multiplying that by 8%, 6/12. So now I have interest expense of 37,337. Notice that that interest expense is going up because my interest, right, is based off of my carrying value, and my carrying value is creeping up closer to the face value of 100,000 every single time I do this. So I know my debits don't equal my credits again, and I once again have to chip away on that discount on notes payable, that contra account. That's going to be for the plug figure of 237. Okay. So the 237 represents the reduction in the discount. So now my balance in my discount has decreased by 237, and that increases my bonds carrying value by 237. Okay. So you need to understand kind of the workings of this, right? You need to understand interest expense is based off of the market rate. And that market rate might include, right, that I issued it at a discount or a premium. My interest paid is always off of my stated rate, and it's always going to be the same. So your interest expense on your income statement changes every period, but your interest paid stays the same, okay? Because that's how much you're paying to that bondholder. So here we're going to work on an amortization schedule super quick, and this is going to look identical, right? Identical to what? My installment notes. Notice the similarities. I have my date, okay? So on 1/1/27, I had a carrying value of 93,205. What happened when I paid my interest? Well, my cash paid, is this ever going to change? No, it's always going to be the same because this is always going to be my face amount or my face value multiplied by my stated rate. Okay, so for every single bond payment that I make for the next 10 years, this is always going to be the case. Okay, now how do I calculate my interest expense? Well, here is where I do my carrying value multiplied by what? My market rate. Okay, so how did I figure that out? Well, in this case, I did my 93,205 multiplied by 8% multiplied by 6/12 for a total of 37.28. So how much did I increase my carrying value by? How much am I driving that bond payable up by? 228, the difference, right? So if I think about this as like 1, 2, 3, 4, and 5, well, here I just have 3 minus 2, my interest expense minus my cash paid. What do I do with that? Well, now I need to add that to my carrying value because I'm trying to get this up to face value of 100,000. Okay, so I add my 228 and I'll get 93,433. Okay, so my cash interest paid is always going to be the same. It's always going to be my 3,500. Why is my interest expense different every time? Because my carrying value is different every time. So now I have 93,433 multiplied by 8% multiplied by 6/12, and that's going to give me my 37.37. 37.37, yeah. So now 37.37 minus 3,500. Notice that's the same way that I plugged my journal entry. My debits equal my credits. I gotta have 237 as an increase in my carrying value to increase my bond payable, trying to pull that up to its face value of 100,000. So my carrying value is now 93,670. Okay. So the last thing I'm going to do super quick is I could say, hey, on December 31st, 2036, okay, 10 years later, 10 years after I issued this, I'm still going to have my 3,500, right? Because I'm going to have a bunch of payments all the way through here. But if you do the math on it, you're going to find that my interest expense in my last year is 39,981. So that means my increase in my carrying value will be 481, and that'll bring my face value up to 100,000, which is exactly what I need. Okay. So if you can understand the amortization piece, the journal entries just kind of fall through. So the amortization schedule is a lot easier to understand and I think conceptualize, right? So make sure you can kind of do both because again, this amortization schedule looks identical, right, to the installment notes payable that we worked on previously. So what's really great about this is that if you can, right, if you can figure this out, if you can issue a bond at a discount, then you can issue it at a premium. Because the only difference, right, is that this premium is because my stated rate, right, if I go all the way back over here, if I issue it at a premium, then my stated rate is greater than my market rate. So if you know a discount or you know a premium, then you know the other one just by association. Okay. So let me know if you guys have any other questions. Otherwise, that will kind of wrap up the guided examples that we're doing for chapter 9. So if you'd like to work through a premium example, shoot me an email and I would be happy to upload a video. Otherwise, enjoy the rest of your day and I will talk to you soon.